I want to talk about President Trump's visit yesterday. As you probably heard by now, President Trump was a little aggressive with me. He kept calling me little man. At one point, he lifted me up like a toddler and literally put me in the corner. He said, "You stay right there until you lower the rates, little man." Then he just left. I don't ever want him to come back to this place, so I'm afraid I'm going to have to lower the rate.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks reversed course on Friday as investors took in a softer than expected jobs report with imminent interest rate cuts seen as certain after this week's run of weak labor market data. And as a result, we saw some very, very mixed price action and some brutal price action here in some of these tech names as it pertains to some of the news we're getting from the AI trade. Microsoft was down 2.55%. Nvidia was down 2.7%. However, on the back of that, AVGO was up 9.4% on its earnings, and software was actually largely bullish on the back of all of this. However, AMD was down. Financials really took it on the chin as well. Eli Lilly was down 2%. Some of the bigger names in the energy sector were down in excess of 2%. And then a couple of the industrials, consumer cyclicals, with Tesla being up 3.64%. Google and Meta also outperformed slightly in the green. A very mixed day across the board. A lot of winners, a lot of losers. This is what the sector analysis looks like. So you could see sectors that actually gained there was a number of them, right? Real estate, materials, communication services, healthcare, staples, and technology were all up. They were all up in a very wide range, pretty much going from flat to up 1%. But the best performers was TLT and gold. And this was really just the market positioning itself into safe havens like bonds and gold on the back of what was extremely weak labor market data. We'll talk about it. The S&P 500 finished flat on the day, and that was led by selling in the financial space, the energy space, utilities, industrials, consumer discretionary as well. Very weird day here for the market. However, we did see some mild outperformance in small caps. Small cap core, small cap growth were both up just shy of 1%. Value outperformed too. Mid cap core is flat, but you can really see large caps took it on the chin today, and that's why the market in aggregate was down. But we did see some outperformance here in the broad market, which is a positive sign, relatively speaking. And these sectors are really just reacting to rate cut expectations. Rate cut expectations are pretty much a certainty after the labor market data we got, and it was not pretty. There's no way to spin this. Not a good look. The consensus was for 75,000. That was what the market wanted. We got 22,000 in the non-farm payroll report. The unemployment rate ticked up to 4.3%. That's actually what we were expecting, but this number was significantly weaker. And it really goes to show that the fact the unemployment rate only ticked up to 4.3% really goes to show that the amount of people leaving the US via immigration is having an impact on this right here. Average hourly earnings came roughly in line on a month-over-month and year-over-year basis, and the participation rate was roughly in line. And on the back of this weak NFP number, rate cut expectations ticked up ever so slightly. A 25 basis point rate cut is all but certain. We may even get a 50 basis point rate cut in September, with the expectations now at 87%. But it wasn't just this that moved the markets. The reason why we actually saw a number of tech stocks fall had to do with OpenAI. They came out and they said that they will start production of their own AI chip with Broadcom. This was after Broadcom's earnings, which was up 9%. And this pretty much means that, if OpenAI and these AI manufacturers are going to make their own chips to run their own products with their own software stacks, that could hurt Nvidia. That could hurt AMD, and that is why Nvidia was down 2.83% today, along with a lot of other fab manufacturers in the tech space. Now, I don't think this is concerning for Nvidia, but the market, reacts accordingly, along with the fact that there was just broad weakness in the market today. However, Tesla bucked the trend up 3.39% after Elon Musk's compensation package came in, and it is looking crazy now. Elon Musk, based on these milestones, could become a trillionaire. And long story short, you're looking at an $8.5 trillion valuation for $400 billion in adjusted EBITDA. Now, adjusted EBITDA is less stock-based compensation. But if Elon Musk goes ahead and hits these milestones, 20 million vehicles delivered, 10 million active FSD subscriptions, 1 million robots delivered, 1 million robo-taxis in commercial operation, and then these adjusted EBITDA figures, if he goes ahead and hits that, his compensation plan could top $985 billion. Totally worth it, I think. And you're looking at, from where the stock price is right now, a potential 8x, potentially even a 9x to get to these figures. Absolutely insane. And then some other market movers in the after hours was Robinhood Markets up 8%, AppLovin up 7% after they will be included in the S&P 500 in the next rebalance. And then for everything we saw today, there was 3,600 advances, 2,600 decliners. Very interesting. Some market breadth. Still solid, even though the S&P 500 did fall. You could see the S&P 500 fell 0.32%. We saw outflows in the Nasdaq 100, inflows in the New York Stock Exchange. Market momentum actually recovered from yesterday to today. So despite the headline numbers in the S&P 500, more stocks gained, and we actually retook the 5-day. We still hold the 20-day. And again, market momentum is telling us that, the volatility we're seeing, it's just a dip buying opportunity. Now, guys, looking at the week that just was, gold was the best performer, and that's to be expected. A lot of uncertainty coming into this week with the non-farms. You can also see TLT bonds up 2%, and they were the best performer for the week. Bitcoin actually up 1.28%. So, Bitcoin still catching a bit of a bid there. We then also saw China outperforming, as well as IWM, and then large cap stocks for the week was up 0.03%, pretty much flat, with the S&P 500 flat and the equal weighted S&P 500 down 0.25%, and then European stocks down 0.5 percentage point. And for everything that happened this week, everything we got, yes, we did see outperformance in gold, but equities were really resilient in the face of everything. The S&P 500 flat after a horrid jobs number. That's probably telling you everything you need to know with regards to where we are in this market cycle and with regards to rate cuts, especially with the IWM small caps outperforming. Year to date, we do see a little bit of a difference. Gold is still the best performing asset here, along with Chinese stocks, and then European stocks sort of in the middle, and then Bitcoin up 14%. And you can actually see things look very healthy, very resilient so far this year. This P500 up 10%, the RSP up 7%, the Qs up 12%, the IWM lagging, but TLT still the worst performing here, up 1.13% for the year so far. But let's go ahead, talk about the day that was. And you can see the S&P 500 was down 0.32%, but that was the only market or the only index that was down. The Nasdaq gained, the Russell 2000 outperformed. Mid-caps and small caps were the real winners here. Even the equal weighted S&P 500 outperformed the S&P 500 and the Nasdaq 100. So despite that labor market data, ultimately we get the weak labor market data, rate cuts all but a short, markets actually rally, are resilient. It's telling you that, the market really just wanted cheaper rates. And if that is the case, we can actually see valuations expand. Probably earnings grow despite the weak labor market data, because rate cuts should solve a lot of those issues we're seeing in the labor market. Now, growth fell, value fell. Again, internationally, we saw European stocks fall on Friday. Middle Eastern stocks were solid. China stocks were up 1.32%. Very, very solid. Indian stocks were slightly down. Now, Bitcoin and crypto, they opened on the weekend, so we'll talk about what happened with them a little bit later. But on the back of the weaker than expected economic data, yields fell. The dollar fell as well. So you can see right here the 2-year and 10-year yield falling, and the 10-year yield officially below or nearing the 4% mark, guys. We were talking about a 5.5% 10-year at the start of the year. These macro bears were talking about a 5% 10-year. We just haven't seen that. The 2-year at 3.5%, now pricing in 100 basis points worth of rate cuts through the end of the year or through this cutting cycle. Absolutely insane. The 2-year yield is pretty much what the Fed funds is going to do. The dollar did form, so the dollar did take a bit of a hit. Now that is good for, equities as a whole, especially multinational corporations, which report in US dollars, but transact in maybe euros or Australian dollars. A weaker dollar is good for from the export side. And then TLT gained 1.52%, and gold and silver gained as well. So the safe havens gained today, but it wasn't completely risk off, because when you look at the equal weighted, when you look at mid caps, small caps, they did perform really well. The Russell 2000 up 0.48%. So it wasn't a completely risk off day, but
it definitely was risk off here in the S&P 500. We had a very volatile week, pretty much finishing the week flat, but we did hit a intraday or intra-week all-time high, and we actually did see the lows that we saw in the last couple of weeks. Quite a volatile week. And if we go down to the daily chart, you can see that, yeah, we had this massive gap down to kick the week off. We bought the dip rally all the way into an intraday all-time high on Friday. And then we actually saw a lot of selling to the lows, right? However, a lot of that selling was actually bought by the bulls. I mean, look at this wick. The bulls definitely did come in. And if we just go to the 1-day chart, right, you can see right here, I had like a waterfall decline, and then the bulls came in, took us high, and we actually made a low right here, higher low into an equal high. That's very, very solid price action we're seeing from this market in the S&P 500. I mean, the bulls did come in today, and we also did see a lot of the bears put in work at the highs. But the fact that, we hit an intraday all-time high, that's really constructive in my opinion. Now, I do think we probably are going to see a little bit of weakness sometime this week or trepid trading. But unless we actually go ahead and break the 6360 area, I feel like this is going to be the line in the sand that determines if we go lower or if we just continue to build a base out here. What a lot of people don't understand, right, is that you can have corrections in two ways. You can have a correction in price where it falls violently, or you can just have a correction in time where, the index trades sideways for like the month of September, the month of October, form a solid base, and then we continue higher. Either way, whatever happens, it will be a correction nonetheless. And I think that's what we should expect here in September. You can see that definitely when we do get to these highs right here, the bears are definitely taking us lower. It's exactly what we saw, but the bulls are buying the dip right here at the 6,300 area because I think they see the writing on the wall. I think, the markets are saying, hey, we could see 68, 69, 7,000 at the end of the year, and the markets do like a 10% return from the 6,300 area, assuming we go ahead and hit the 7,000 mark by the end of the year. It's a big stretch, but definitely can be done. Now, the Nasdaq 100 was actually positive here today. We didn't hit an all-time high, but we did go ahead and break above this high again on an intraday basis. And this chart still looks very, very constructive, bouncing off the gamma flip right here, making higher highs relative to this high. I mean, we could actually go ahead and hit an all-time high if Google, Meta, Apple, let's say maybe Nvidia acts well. Next week, we definitely go see an all-time high for the Nasdaq 100, but I'm expecting very much the same in the Nasdaq 100 like the S&P 500, just trepid trade, maybe a little bit of downward momentum, a correction in time, maybe a correction in price as well, of getting ready for a move into the end of the year. The RSP, solid day, very, very volatile, but pretty much at these all-time highs. Didn't quite make an all-time high, but pretty much an equal high. If you look at it, looking at mid-caps up 0.5 percentage point, that's a 52-week high close. Absolutely insane, along with the S&P 600, a 52-week high close and an intraday high as well. You love to see that. Things looking very, very solid for these assets. I mean, that's a very, very solid return we've seen here. In mid caps and small caps, they're really outperforming. And I do think if we get 100 basis points worth of rate cuts, that's really going to spur on investment and growth. And, we're going to see earnings accelerate into 2026. And that's why these markets are staying relatively resilient. So we just have to get through the volatility and the churn we're seeing right now in this market, right? Especially the September, potentially October period. But then we're looking for a really strong end of year run. And that is still my base case at the moment. That is subject to change. I do reserve the right to change my opinion at any point, but that's what I'm looking at right now. Let's actually go ahead and talk about crypto now. Crypto has been open for a lot of the weekend. Bitcoin's still holding this 109 area right here. You can see we sort of put in an equal high, a lot of volatility right here, as you can see. But I think as long as we hold this 109 area, yeah, we can dip below it. We can. But as long as we just hold this area, I think Bitcoin is still poised to go higher. I think Ethereum looking very solid. As long as we hold this 4,000 area, I think Bitcoin, Ethereum is onward and upward from there. Now, guys, let's quickly look at the 2-year here. We're sitting at the 3.5 area, right? So right now, the Fed funds is at 4.5%. So the 2-year is telling us that we're looking for about 100 basis points worth of rate cuts this cutting cycle. And this can actually increase further if we continue to move lower. The 10-year yield is at about 4% right now. So it's actually below the Fed funds rate. So definitely the Fed needs to cut. The Fed is behind the curve. We're in a clear downtrend right here. I think the Fed needs to do 100 basis points worth of rate cuts very, very quickly, sort of just to normalize what the real effective Fed funds rate is. If they don't do that, they continue to strangle out the economy. And we are starting to see that in the labor market data. Now let's have a quick look at gold. You can see we are officially breaking out above this key area right here. This is exactly what we said would happen. We're looking at this, breakout above. We're now moving above this line. I think ultimately, if gold is to pull back to this 314 area right here, that would just be a dip buying opportunity for us to go higher. I think we see 4,000 gold, especially in the the futures, right? I think we're going to see 4,000 gold before the end of the year. We're now at about 3,600, somewhere around there. Guys, and diving into sentiment, this is the fear and greed index, and we are right now here in neutral sentiment. We've pushed from the greed zone this week into the neutral zone. This can somewhat be seen as bullish. It can also be seen as bearish, especially as the NFP numbers did miss expectations. We'll talk about it. However, rate cuts are coming, and this does suggest that there is room for optimism to grow without the market being overheated. Sentiment being in the neutral zone and potentially even pushing into the fear zone could trigger somewhat of panic, and if sentiment continues to push into neutral, into fear zone, that could trigger panic, and that is our opportunity as investors, especially if we do look in the medium term. It's very likely that we are going to be significantly higher 3, 6, 12 months down the track. The thing is, we could just see some near-term volatility. Now, generally speaking, after a 5% summer rally, so June, July, and August, if returns are greater than 5%, what are the returns we can expect for the rest of the year, specifically September to December, right? The expectation is that we can actually see a 2.84% return, 18 wins, 6 losses, right? And we've returned 9.28% in this period. And you can actually look at the September percentage return. We actually get 14 wins, 10 losses, right? And then in October, we actually have 6 wins, 18 losses. So do expect quite a bit of volatility over the next 2 months, but then November provide absolutely stellar returns. And if you actually go ahead, sort of buy the lows, buy the dip that we may get in September or October, you can see extremely outsized returns. And I still think that the returns are going to be driven by technology. Why? Because they're the only sector in the S&P 500 that has actually got cheaper on a price to earnings basis. You could see here that EPS has grown 15% for the year. Price has returned 13.8% for the year so far. That means the PE multiple has actually decreased by 1%. Very, very solid stuff. And we do know that rate cuts are coming, guys. And this is why I remain constructively bullish. Don't get me wrong. I think we're going to see a lot of volatility in September and October. But if we do get those rate cuts and we don't get a recession, markets tend to be very, very strong. In fact, when we get a rate cut and we don't get a recession, the S&P 500 tends to return 15%, 200 to 250 days later, pretty much 1 year later. However, if we do get a recession, right, you could see that markets tend to churn, and we actually tend to see lows of negative 15%. However, are we going to get a recession? The data right now in the macro is telling us very mixed things. I mean, economic growth, right, is still at about 3%. This is for Q3, the Fed GDP now estimate, and all a recession is 2 quarters of negative GDP growth. According to this, we're not seeing it just yet. However, there are some concerning things, the most being the unemployment rate. That is sitting at 4.3% right now. That ticked up from 4.2%. So not a disaster. It's still sitting at, 50 lows compared to what we've seen in the history of America. But the unemployment rate is moving in a direction you don't want to see. And this probably has to do with our unaccommodative rate cut policy. But ultimately, what's going to matter now going forward is the data from here on out. Now, we don't have a lot of data next week. The big thing is going to be Thursday. We get the CPI data. So we get the core inflation rate and the headline inflation rate. So on the year-over-year figures, we're looking for a 2.9% number right here. The forecast is for 2.8. This would still be a slight increase from the previous month. At the core inflation rate, the year-over-year figure we're looking for is 3.1%. That is to remain flat from the same month previously. We also get the PPI before the CPI. That's very, very interesting. We also get the non-farm payrolls annual revision here in September, and then we get the initial jobless claims on Thursday. So we get inflation data, some employment data as well this week. That's really going to move the market in the week ahead. In terms of earnings, we are approaching the end of earnings season. We do get Casey's and the Planet reporting here Monday before and after the close. The big one is going to be on Tuesday. Oracle is reporting. We also get Rubrik, the AI company. They're reporting as well. GameStop, Synopsys, and Aero Environment. Chewy reports on Wednesday before the open. Kroger on Thursday after the open, and then Adobe after the close. I think a lot of people are going to be watching this. A lot of people are also going to be watching Oracle. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.